This is Fintech Insider News. This week, global banks join SWIFT in a blockchain overhaul plan. The UK mandates digital ID cards. What's the impact for fintechs? And JPMorgan says bye-bye to Nutmeg as part of its digital wealth revamp. We'll be discussing all of this and more on today's news show.
This episode is brought to you by Infuse, where agility meets scale, where compliance meets confidence, and where bold ideas become reality. Find the only place where card issuing and processing comes with happiness built in. The Infuse modular next-generation platform gives you exactly what you need, from BIN sponsorship and scheme access to compliance and fraud prevention, while you stay in control of your customer experience and roadmap. Infuse, innovative card issuing and processing that fuels innovation. Discover more at infuse.com.
At Thales, we know cybersecurity can be tough and you can't protect everything, but with Thales, you can secure what matters most. With Thales industry-leading platforms, you can protect critical applications, data, and identities, anywhere and at scale with the highest ROI. That's why the most trusted brands and largest banks, retailers, and healthcare companies in the world rely on Thales to protect what matters most: applications, data, and identities. That's Thales, Thales. Learn more at thalesgroup.com/cyber.
Hello and welcome to episode 1003 of Fintech Insider, brought to you by 11FS, the 5-time consultancy of the year that works with banks, investment firms, digital banks and fintechs around the world to build the next generation of digital financial services. I'm Benjamin Ensor, Director of Research and Strategy. Well, autumn is in full swing in the Northern Hemisphere, and as October brings cooler temperatures to us, the news is heating up in parts of fintech. With the annual Cybos conference happening in Frankfurt earlier this week, we're here to bring you the latest stories from inside the conference halls and beyond. So let's dive in. We've got 3 people helping us deal with some of the news this week, our panelists, so let's meet them. First of all, it's a very warm Fintech Insider welcome to Sam Alarko, co-founder of Paygentic. Welcome to the show, Sam. Can you introduce yourself and tell us a little bit more about Paygentic, please?
Sure thing, Ben. Thank you very much, and thank you for welcoming onto this podcast episode. Really excited and really honored to be here. My name is Sam. I'm co-founder and CTO at Paygentic, so hope to speak a little bit about that later on. Basically, our mission is to help companies to monetize AI services, AI software, with the newest billing techniques, and also to help them orchestrate cross-border payments, specifically in B2B settings.
Fascinating. We also have a Fintech Insider return for Stephen Richardson, Chief Strategy Officer and Head of Banking at Fireblocks. Welcome, Stephen. It's great to have you on the show from Frankfurt. Can you tell us a little bit more about you and your role at Fireblocks, please?
Yeah, of course. Thanks for having me. My name is Stephen Richardson. I'm the Chief Strategy Officer and Head of Banking at Fireblocks. Fireblocks is a digital asset infrastructure company. We're really focused on providing what we call core banking for digital assets. So wallet technology, product capabilities across tokenization of assets, payments orchestration, to really help financial firms, fintechs, and crypto native firms engage in building products in the digital asset space. So we're really an infrastructure provider across the board, in digital assets.
Fantastic. Thanks so much for joining us again. And it's also a Fintech Insider return for Samantha Emery, Financial Services Executive and Non-Executive Director. It's really great to have you with us. Can you introduce yourself for our audience, for people who've not come across you before?
Absolutely. And firstly, great to be back. These are always fantastic fun. So I've worked in financial services for almost 2 decades now across transaction services, payments and innovation at Tier 1 banks, at the regulator, the Financial Conduct Authority, and with public and private fintechs, including SWIFT, where I served as the board's deputy chair. So it's just a real holistic lens on the ecosystem that I found absolutely fascinating since I first landed in it. And I did have a check back. I think the last time I was on Fintech Insider was on behalf of the FCA. And I was talking about a number of things, including the potential for a cross-sector sandbox, which actually feels, well, several years later, somewhat timely given the current activity in the smart data space.
Fantastic. As a quick aside, we understand you were an attendee at the launch of Black in Fintech last week. Can you just tell us a little bit about what that is?
Absolutely. So I do so very much on behalf of its founder, Valerie Contour. Black in Fintech is really, it does what it says on the tin. It is a community for those in and around fintech who are Black and brown people of colour, who basically have been underserved, have been shortchanged by the financial services system. And we know part of this is down to the fact that we do not have the right level of diversity in a lot of the rooms where decisions are being made, where funding is being secured, where product design is happening. And that's not only meaning that people aren't involved in the conversation and the products aren't getting designed. So let me just repeat that. So that doesn't just mean that people aren't involved in the conversations and the right products aren't getting designed. It actually means we're not tapping into opportunities just through understanding different cultural norms of money management that actually work, that actually service communities today, that we don't promote in a Western-led banking and product service environment at the moment. So it's really bringing the community together around that, finding its voice and looking at how we can bring that to the mainstream.
Fantastic. Thank you for sharing a little bit about that and reminding all of us to try and think from a whole variety of different perspectives. Okay, well, let's get into our first story, which is that Swift and leading global banks are working on a blockchain-based overhaul. So Swift and more than 30 banks, including JPMorgan, HSBC, Deutsche Bank, BNP Paribas, are developing a blockchain-based shared ledger to modernize cross-border payments, aiming to make them instantaneous, cost-effective, and available 24/7. The new system will support interoperability with emerging forms of digital money, including stablecoins, tokenized bank deposits, and central bank digital currencies, or CBDCs, while preserving Swift's existing compliance and security standards. Smart contracts will be used to validate transactions, enforce rules, and maintain accurate sequencing, giving the system programmability and transparency not available in traditional systems. And the move responds really to rising pressure on Swift to evolve, with forecasts predicting stablecoin circulation could reach $4 trillion by 2030. Stephen, I think it makes sense to come to you first, as you've been in Frankfurt and you were at Cybos. How big a deal is this that Swift is embracing blockchain after sort of years of criticism that it's a bit outdated and so on? Is this a turning point?
Yeah, look, I think it's exciting that there's been a bit of a shift in terms of the approach towards looking at blockchain and digital assets as a whole, right? So, I think, holistically, if you look back in the space probably 2 years ago, there's much more of a bigger movement towards looking at things like central bank digital currencies, tokenized deposits, and stablecoins were a bit of a fad in the space that were kind of relegated to, crypto native firms and trading. I think what you've seen is that stablecoins have proved utility in terms of solving the issue around things like cross-border payments, both on the retail and the corporate side. And they've really validated itself, and its use cases validated itself as a real commercial opportunity. One of the first big ones in the blockchain space. I think we anticipate there'll be additional ones outside of crypto native trading. But if you think about something that moves beyond the scope of digitally native firms, stablecoins was the first real commercial use case that broached that boundary. And so it's good to see Swift respond in kind, right? In terms of how could they participate in the space? And it's a turning point in which, you see 30 member banks look and acknowledge that stablecoins and blockchain in general is something that, should be embraced at a technological perspective. I think, it's to be seen, right? banks have looked at things like permission and private blockchains, specifically private blockchains, for a while in terms of things like asset aggregation and in some ways whether or not it's inclusive. I think the one exciting thing about stablecoins today is it's an inclusive ecosystem. USDC, USDT, PUSD, USDG, which are stablecoins in the market today, they operate in an open ecosystem. They operate from everyone from a corporate being able to interact to it with the bank to a retail consumer that has a wallet, right? And the question that I think maybe comes up a bit is, what is the architecture of this going to look like moving forward? Is it going to be member-only led? Will it include fintechs? Will it include, digital providers that are in the space? Will it be open and inclusive, or will it be something that was built to, enable, a certain subset of the financial ecosystem to participate? I think that question is still open. Obviously the announcement is across these 30-member banks, but I think it's, to be seen whether it'll be an inclusive ecosystem and, it'll be something in which, many providers, many wallet providers are able to plug into and to utilize. If it does that, I think, this is really exciting. If it doesn't, I think we'll see the broader implications of that. So, I think it's exciting to see, this conversation happen and to see what kind of changes over the next few months to a year, happen in terms of the broader rollout of this technology from Swift.
Samantha, you're quite familiar with Swift. What's your take on this story?
Yeah, I very much echo a lot of what Stephen's already talked to. I think for me, really exciting move, really positive move. And I think to the point of sort of outdated, yes, there could have been a world in which they moved sooner, but financial services as a whole has been massively dogged in the incumbent space with stack upgrades. In the core space around Swift, the community chose to adopt new standards, and that's all taken up some headspace. But I kind of lean towards the fact that innovation is never just about what, but it's about when. And I think since the conversations first started, the technology's matured, the customer expectations of always on, instant as standard, that's all shifted. But for me, what has been the biggest shift and possibly the most material shift that supports us getting to this announcement is that around the policymakers and the regulators, which Stephen's alluded to. So when I was last on this podcast, I was at the FCA, I was leading the Innovate department. We were developing the first taxonomy of digital assets. I was there leading some of the sort of inputs to the conversations between ourselves, the central banks, IOSCO, when Libra popped up, if anyone still remembers that. We're in a very different place in time now. The US has gone full 360 on its embracing of stable coins. The ECB is obviously pressing ahead with digital euro. And even closer to home in the UK, the Bank of England governor has signalled the need for acceptance of a multimodal system. So one of the things that Andrew Bailey said relatively recently is just a point of reinforcement that credit creation could be split from other banking services. And this is relevant because the conversation around credit creation was one of the main arguments that the big banks put against CBDCs. So Swift have stepped into this conversation, but for me, at a time when the likelihood of success is greater, and actually, if we imagine a sliding doors world, they're probably going to overtake the version of themselves that was an early mover.
Just trying to get my head around your sliding doors concept. But yes.
No one outro.
I do, I know, I know the film, indeed. Other Sam, one of the interesting things here is Swift, of course, member-based organization. It's horribly complex when you're trying to drive innovation with many, many firms. Innovation is always hard, but when you're trying to get innovation and you're trying to get lots and lots of firms on board, how much more difficult does it become? It's one thing to have, fantastic ideas and work out the technology. It's quite another to get 30 plus firms and then to Samantha's point, get all the regulators on board. How big an achievement do you think this is?
I think this is amazing. I'm personally very excited by the initiative and the announcement. Like Stephen said, a question in my head is how open this ecosystem is going to be. I think just the fact of having a shared ledger in the blockchain shared between these banks is going to introduce a lot of efficiencies, a lot of speed, a lot of automation. It's solving a lot of the problems that traditionally Swift and other similar systems have, like all transactions have to be sequential. There's all these intermediate steps. A shared ledger certainly will help in that. But of course, how many other players outside of this club are going to be able to participate? One of the big ethos of blockchain is interoperability and openness. So how much in that direction is this going to go? I think that's an open question. And also, while I was reading on this, another question in my head, given the proposal to use smart contracts, is what are the security implications around this? I mean, there's a lot. This looking back at history, there's been the immutability of the blockchain is a plus, but also a minus when there's security breaches. How are these going to be mitigated if the system is going to interoperate among all of these asset classes and among all of these layers of interaction? It also increases the attack surface on the whole protocol. So how are all of this going to be mitigated? It's a question in my head, but all in all, I think it's a very big achievement for the blockchain space, for the whole area of stablecoins and CBDCs, and I'm looking forward for it going ahead. I'm optimistic, but at the same time, maybe a little bit realistic. I think these things move slower. The announcement is good, but it's going to take a while to get there. But I think it's a good sign.
Stephen, when things like this happen, we always sort of think a little bit about like, well, who wins, who loses here? And you rightly raised the point of that Sam's just made as well about, how open it is going to depend. It's going to have quite a big impact on whether it succeeds, but also maybe who sort of wins and who loses from this. What would you like to see happening? It sounds like you want to see this open. You want to see all sorts of fintechs able to take part. What would you like to see? What do you think the right path forward is?
Look, I think Sam brought up a good point around, the security and the basis around smart contracts. And, at Fireblocks, that's one of the things we focus on, right? Because it is so complex, right? I think there's been like this ethos initially towards things like private blockchain, right? Which make it hard to scale, right? So, in order to kind of leverage private blockchain, you have to actually leverage building out and giving capabilities to build wallets and all the infrastructure behind that, and then extend that infrastructure to others, right? Even on like the permission basis, which is a bit easier, it's still something that's a bit more complex, right? And so, for me, I would like it to see it as an open ecosystem, right? Because in essence, as you have an open ecosystem, you have like the evolution of the different services and the different participants, right? I think what's happened so far, right? And we look at stablecoin usage, at Fireblocks is, you have it both happening at the retail P2P side. You have it happening at kind of the corporate remittance side. And then you have it happening at the, large corporate institutional side, right? And in terms of each of those are basically finding use cases to move money efficiently and programmatically, right? And they're doing it at an extension of, through hubs, which could be PSPs and fintechs. They're also doing it direct at a P2P level, right? And so the question is, do you stop that extension of the technology and the utilization of money on chain? I'm not sure that you do, right? I think when you think about an open ecosystem, the one thing that benefits banks is, they have an infrastructure that allows for like credit, right? And for services that generally other fintechs can't provide at the moment. I'd be remiss to think that as you look at like the space in which fintechs, PSPs, telcos are building infrastructure, e-commerce platforms are building infrastructure to support things like digital wallets, that they would like seed that infrastructure to, banks holistically. I think it's more around thinking through how do you interact with an open ecosystem, and then how do you build a great UX UI that attracts and keeps customers utilizing your platform, right? And I think there's a question of whether or not banks start to extend themselves to thinking about themselves as a technology company, not only as a financial services company, and building products that will allow, consumers and corporates to keep utilizing them, right? I don't think that at the end of the day, there's risk for large corporates to leave a bank tomorrow if a bank builds a really great UI that allows them to connect with a blockchain and move money more seamlessly and programmatically, right? I think it'll be a problem if at the end of the day, there's only a network in which, money moves on a blockchain to a certain set of participants, and within the ecosystems that these corporates in emerging economies and others need to move capital, they're not able to. And then they start to work outside of that. So I think competition in some ways is a good thing, right? But I think there's inherent benefits to where banks operate today, and they should see that, right? And then build an ecosystem that kind of aggregates assets in a whole, right? If you think about why people launch assets and tokenized assets on things like Ethereum and Solana, it's because there's an ecosystem there, right? And that ecosystem includes both institutional participants and retail participants. And so I think that's an important thing to consider. If you look at what's happening in the payment space with things like Tempo and Circle Art, which are blockchains that are built for things like payments, they're open in nature, even though, right, for someone like Circle or for someone, for others, right, it could be disruptive to have people operating on the same rails, right? But there's a question of, can you build a great UX and UI experience? And can you basically enable people to utilize an asset in a more effective way? And so I think that's how people need to be thinking about this problem, rather than do we block people from participating in an ecosystem that's already evolving outside of banks in and of itself.
I love that thinking. Okay, well, we need to move on to our next story. Thank you for the perspectives from Cybos. Let's move to our next story, which is that the UK is mandating digital ID for right-to-work checks, sparking some fintech innovation concerns. So the British government has announced that it will require digital ID verification for right-to-work checks by the end of the current parliament, aiming to reduce illegal employment and simplify access to services. The digital ID will build on existing platforms like the National Health Service app and the gov.uk digital wallet for broader government service access. However, fintech and regtech leaders such as Janine Hurt have been vocal in their concerns that this government mandate could limit innovation and crowd out private sector identity solutions. So we actually asked some of our followers, some of you, our listeners, whether you thought this digital ID mandate would be good for innovation in fintech. And here's some of what you said. 59% of you said you believed it would promote innovation, with 17% saying it would hinder, and another 17% saying it could do both. One of you replied, "I love the idea, but there will be unintended consequences, and we have no idea what they are yet." Samantha, I'd love to come to you first on this, as someone who's been both a sort of poacher and a gamekeeper, and you decide which is which. Do you think the government has sort of thought this through fully? Do you think there is a risk that a government scheme takes years, crowds out private sector, or do you see this as a positive move forwards?
So let's start with the positive, shall we? I think really positive that we do now have government support for the digital ID conversation in principle. And I think this is critical because it underpins so much. So I was sponsoring some of the Ghana Review inputs and early national payments vision responses at UK Finance. And this was very much a key enabler for that next generation technology coming through. And the same can be said for things like agentic AI and how that can be used safely. It all requires that enablement that a digital identity provides. However, the approach of mandating it as a government-delivered identity was a surprise. And let me just unpack why. We are the country that were the open banking framework pioneers. We are the country, as I just mentioned, that has been living the legacy of over-centralizing payments innovation. And we are the country where the government wants the private sector to drive competitiveness. So for me, these are all things that might logically point to a different outcome. So I do see the risk of hindrance. I do get Janine and others' comments. And I think you just have to think about where the track record of delivery sits and time to market, what we have in terms of a massive complement of regtechs and fintechs that already operate in this space that could ultimately face over consolidation. And worst of all for me, it's taken us a long time as a country to really progress this conversation to where it's gotten to today. But we just risk distraction as the whole conversation and debate turns to culture wars around nanny state immigration. And I don't think that's what the government would have intended, but it looks like that might be where we're heading, given some of the early response to this.
Sam, as other Sam, as someone who didn't grow up in the UK and is perhaps a little bit more neutral, what's your view on this? Is the UK just sort of tying itself in knots here? What do you think?
Well, like you say, I don't have a strong opinion on this. I think in general, identity is something that is something of public interest that government plays a role in. And in other parts of the EU, we have all the electronic national identity cards, etc. And we've seen good examples of this working in a balanced way, like in Singapore with SignPass. I think it's all about achieving a balance. I do see the risk that other people have mentioned of it affecting innovation in the private sector, or I've been reading about this industry here in the UK, and a lot of innovation about ID has come from the UK and from UK companies. And this, I agree that this initiative from the government can disrupt that whole industry, which I don't think it's something that's desirable, certainly. But I think there is a way, and we have proven ways from how other countries like Singapore have done it, to balance the innovation from the public and from the private sector in a way that benefits both through open APIs. And I think open banking, like Samantha mentioned, is a very good precedent of how that can happen, while at the same time having that rigor and that assurance. I think if you put all of those together, you can reach a good balance, and that's my hope. Not having a lot of stake on the game here, but at least for the UK, that's my hope.
Stephen, it feels to me like we're almost back in the previous story about what should be centralized and what should not be centralized, and who should have access to sort of central, the central systems and how things should be managed. Am I imagining that the parallels there?
No, I don't think so. I mean, I live in Singapore, right? So I'm used to a digital ID on my phone through SingPass, right? And actually, what's interesting around that in terms of the accessibility and the API basis is what that allows fintechs to be able to do to validate who's interacting with systems, right? I think I'll kind of bring this back to a parallel for things like blockchain, right? If you think about things like payments flows in blockchain, where we're seeing a lot of innovation from fintechs, one of the big regulatory requirements is around things like KYC, right? And the ability to know your customer and to know and the AML around that, right? And as you think about a system which money is starting to move more freely, the idea of, a digital identity being able to be tied to something like an on-chain wallet is something that's interesting. And the question is, like, should everyone have accessibility to that information such that wallet providers globally are able to tie into that? Or should it be like privatized, right? I think that's always going to be the consideration of like, what kind of utility does that start to bring about, especially around innovation around the edges, right? Because I think digital identity innovation is one thing, right? But then you start to think about financial services innovation, right? And what's required to be able to do that, in a regulatorily compliant way, right? And I would assume that the cost basis of getting, that type of information from the government would be significantly less than the cost basis from a privatized basis. And therefore, maybe you have spurring of more innovation by firms, in these other areas, but not necessarily in the digital identity area, right? At the same time, you get to a point where, as Sam mentioned earlier, it could take a very long time, and then that hinders kind of the innovation that you'd see over a period of time as well, right? And so, for me, I look at places like Singapore where that's worked really well. And so I see the opportunity to have something as a centralized government utility that provides services to others in the innovation space. But I also think that I'm not as familiar from a UK perspective in terms of how long it takes to create that kind of innovation, but if it does take a long time, you could see that put, the UK behind other geographies in terms of, the ability for firms to be able to access that information and really build upon it from an innovative stance. And I think that would be a bad thing for to happen overall.
Thank you. I'm loving the parallels with Singapore and it's the lessons that can be learned from there. Samantha, I mean, people in the UK will know that the government's announcement of this is probably driven by sort of internal politics and immigration and so on, which is not the subject of this podcast. But it does mean that the government's announcement has perhaps been a little bit rushed, perhaps not completely thought through. Do you think we might see the sort of government just sort of, as they think it through, coming back and getting this right in 2, 3, 4 months' time? Or do you think perhaps they're sort of determined on this course of central government services and the sort of big government IT project to sort of build this over the next decade, to Stephen's point, so that we're however many years behind every other country?
Benefit from in the UK is a very open and discursive relationship between the private sector and our regulators and policymakers. Now, announcements come and go. There's the drum roll and then there's the next day. And when we start to get into the weeds of this, when some of the practicalities surface, a lot of those unintended consequences and implications may become apparent. And I think if we take the same approach to what we have been doing with the likes of open banking, with the likes of the national payment vision, and actually really ensure we've got that public-private partnership, I think we can nudge this in the right direction. And Stephen talked about sort of criticality of access. We've got things to kind of look left and right on for that mean we don't have to build from scratch. If you think about sort of payment systems access and what we have around sort of pond and making sure that people aren't unintentionally locked out of their abilities as an organization to access the system. Those are things that could be replicated in a slightly different model for digital identity than what the government has set out so far.
Thank you. And Sam, just quickly, you made the very good point when we were talking about Swift's blockchain plans, that it was creating potentially some quite big surfaces for fraud. In principle, do you think a sort of single government-controlled system is more secure, or do you think actually it's better to have a bit of redundancy of having sort of lots of private wallets and private ID systems drawing on central system? Do you see a security angle on this?
Yeah, it's definitely a good question. I think centralization is always going to bring a security risk. It always happens, and decentralization kind of spreads the risk across multiple parties. I do think that it's inevitable that certain parts of the digital identity will be centralized in a government scheme. I just think that that's what different countries are tending to, and in one way or another, it will probably happen here in the UK. The question is, how can user-centric permission and security be implemented in a way where the user is always in control of what information gets shared with whom, both when, especially when private entities are requesting access for that information. How transparent is that process and that permission structure, and how is that communicated in the user experience? I think it's not devoid of risks, and that's something that needs to be taken into consideration. But I think it's just something that will happen and that we'll have to deal with.
There's a lot of work then for the UK's regulators to do to really think through exactly how this is going to work. Okay, well, on that note, we are going to take a quick pause here, and we will be back very shortly.
Finished training for the day? Time to fight post-workout fatigue with Core Power Protein Shakes. They're packed with 26 grams of high-quality protein to build muscle and electrolytes to help hydrate. The nutrition you need to help your body replenish, rebuild, and repair post-workout so you can power on to the next one. Champion your recovery with Core Power. Visit corepower.com to learn more.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's vanta.com/insider.
Before we dive back into the news, a quick heads up on our latest Insights episode. We're exploring who's really ready to serve customers in a digital-first world. It's not traditional banks versus digital banks anymore. It's about which firms can meet customers' rising expectations, stay compliant, and scale fast with the right technologies. Are established players modernizing fast enough to pull ahead, or are digital banks still leading the charge? We partnered with Infuse, the next-generation issuer processor powering card programs and payments for both banks and fintechs, to dig into what it really takes to win. Catch the episode now. It's on the same feed as this one. And now back to the news. Our next story is that Paygentic has unveiled AI-first payment infrastructure for next-generation applications. Paygentic positions itself as the payments and billing infrastructure tailored to modern AI-driven apps, addressing challenges that traditional billing systems can't handle. It offers a single platform that combines flexible pricing models, such as usage-based, outcome-based, and hybrid, real-time balance enforcement through wallets, and integrated payment processing. The system enables instant checks on usage, prevents overspending, enforces limits, and delivers live analytics and dashboards for both the provider and end users. By providing one API and consolidating billing and payments, Paygentic aims to reduce engineering complexity and allow builders to focus on core product features. So Sam, it's really great to have you here to tell us more about this launch. Can you tell us a little bit more about some of the problems that Paygentic aims to solve that established infrastructure is struggling with?
Definitely. Thank you very much for mentioning this on the show. Yes, so we started Paygentic with the aim of helping new companies meet the challenges both around billing and payments that new agentic applications are bringing to the table. So what we see in the industry is that there's basically a new category of software, which we call agentic applications, agentic software, that is paid for and consumed in ways that haven't seen before. Whereas SaaS models introduce monthly subscriptions, some usage-based billing, but generally reconcile at the end of the month or at the end of an annual contract, and with not that much variability. What we are seeing now is software consuming other software, making decisions on the fly, and needing much more data on the cost of those actions. For example, we have customers that are selling financial data to agents, things like live prices, historical prices on stocks, but they don't know in advance which data sets are going to be accessed, how they're going to be accessed, and what agents are going to do with that. So they need to, in real time, give these agents accessing the platform a budget, have the agent be aware of the budget that they have while they're doing actions on the platform. Each event has to be priced in real time. You cannot wait until an hour or until the end of the month to decide how much that was worth, because the agent or the company driving that agent needs to know at that moment if they're within budget or not. And the margins, whereas before the SaaS margins were traditionally very big, now with the introduction of LLMs, those margins are being reduced drastically. The LLMs are a big part of the cost of these new software products, and therefore spend needs to also be controlled much more. So what Paygentic aims to do is to create these payment experiences for this new era of software, and to help both merchants and consumers monetize their applications and pay for these applications. There's another example. There's a lot of pain points around managing the expense when it's variable. So CFOs that are consuming these products have no visibility into what's going to be the end of the month cost. Sometimes they have to wait until the end of the month to realize. Engineers also don't have the tools needed to predict spend. So what we're doing with Paygentic is bridging that gap between the merchants and the consumers, providing both the billing and the payment tools in an integrated platform. There's lots of billing, usage-based billing, outcome-based billing software out there, a lot of it coming from the UK, by the way. There's been lots of innovation here, but many times they lack the payments aspect. Merchants have to then integrate with a payments provider and kind of stitch both of them together. What we aim to do with our platform is add, let's say, a payments wallet functionality on top of the billing so that merchants get a complete solution with our platform. So yeah, it's been an amazing journey. We are just launching out of stealth this week, and we've been working with a number of design partners, and now we are onboarding the next phase. So yeah, super excited to be here. I've been meeting customers before coming here, and we are ready for the next phase of the business.
Well, congratulations. I mean, it's a pretty complex problem that didn't even exist 5 to 10 years ago. Stephen, I'd love to bring you in, and Samantha too. But Stephen, I imagine this is sort of somewhat up your street. This sort of whole topic of sort of programmable payments and the sort of concept of sort of AI agents and so on starting to act autonomously. What do you think of this?
Yeah, look, I think if you look at kind of, I'm going to draw a parallel to what we're seeing in like the crypto native space. You actually have like AI-based orchestration around things like stablecoins today, right? The idea that you would tie an AI agent to a wallet, and that wallet would then be able to allocate capital based off of different trading strategies, et cetera, within the space. You're seeing that on the basis of like AI-based fund management, right? So AI agent then being able to allocate capital for effective trading to execute fund strategies, right? I think it's only fair that you then start to see that in the basis of how people interact on a commerce level. And so, this idea that, basically as you're bringing money on chain, right? The ability then to take advantage of tools on chain becomes a much easier basis to solve, right? And it's one where you can tie in the orchestration and the programmability in a way that really provides utility to the user. And I think that's really interesting. And one can only think about the different kind of user experiences that then start to get created, the transparency around information, but also the ability to really scale, right? I think we always hear about these companies nowadays that are using AI with, 2 folks to be able to then develop businesses with, a few $1 million worth of ARR all at once, right? And so you can think about, for anyone that has a really interesting idea, access to money on chain and ability to really leverage AI, they might be able to build competing businesses in a space to really solve problems and scale them at a level we haven't seen previously. And I think that's really what's exciting from an innovation perspective. And, that's what the technology will allow people to do. Now, obviously, things like regulation will come into play and what that means. But, at the moment, it's a bit of a white space to really be able to explore.
Really interesting. Samantha, what's your take on this?
Yeah, so I've been talking increasingly around possibilities in the landscape of agentic commerce and payments. And I think this is quite interesting because you are looking at one of the solutions where you are not just leveraging AI to tinker around the fringes of existing workflow. You're doing pure play reimagination, and that's where you do really get the sort of value add and the competitive advantage that I think is going to make a difference in the future. And I think to echo what Stephen's talked to, a lot of this agentic technology has the opportunity to democratize a lot of financial intelligence and guidance that for a long time has been the purview of those that can afford the advisors, the consultants. And you get that in your pocket as an SME going forward in a way that's really powerful, understanding how to optimize your working capital, how to best manage your cash flow. That wouldn't have been possible 10, 15 years ago. So it's not just a game changer in terms of how it could alter the value chain in the ecosystem itself for payments. It's those end customers and consumers and businesses and what it can do for them in terms of upping their financial literacy, financial management, and business management. And that's really exciting because, again, the story from the government is growth competitiveness. So we really want to push ahead with solutions like this.
Thank you. Sam, what's next for Paygentic? I mean, coming out of stealth is fantastic. What are your plans? Where are you hoping to sort of grow? Where are you hoping to go next?
Yeah, definitely. Right now, our plans is to grow in terms of customers acquisition. We want this solution to reach everywhere. Right now, our main markets are Europe and the US. We've partnered with a number of regulated payment providers, but we are in the process of seeking our own internal regulation to basically be able to expand our operations. And, our dream, not on our dream, our objective, our mission is for Paygentic to be the default platform for software monetization in the agentic space within the next years. So that's what we're driving for. That's our plan. And so if you know of anyone trying to monetize an agentic software, bring them our way.
I think there's probably quite a few listeners who are doing exactly that kind of thing. So fantastic.
Thank you.
Congratulations. Well, let's move on to our next story, which actually stays in the same area of AI and payments. So our next story is that OpenAI and Stripe have partnered for ChatGPT payments. So they are partnering to enable American ChatGPT users to make purchases directly within the chat interface, initially offering single-item purchases from Etsy merchants. The integration uses the Agentic Commerce Protocol, ACP, an open standard developed by Stripe and OpenAI, designed to facilitate seamless and secure transactions between AI agents like ChatGPT and merchants. Stripe has introduced shared payment tokens, which allow ChatGPT to initiate payments without exposing customers' full payment details, so increasing security. And the Agentic Commerce Protocol, ACP, framework provides a standardized way to engage in agentic commerce while retaining control over payment systems, customer relationships, and existing infrastructure, enabling a smooth transition to AI commerce. Sam, it does seem kind of logical to start with you first, because it's particularly your field. Is this a big deal? Is the ability to buy products directly through ChatGPT? Is that the future of e-commerce? Is this the start of the future?
I think this is a massive shift in the industry in ways that we're only going to see in the coming year as this gets adopted. We've seen how, let's put for example, search. Before, people used to go to Google for searching, and you used to click on a link, read a website. Now, a lot of people that I know, myself included, don't use Google for most of their searches anymore. They use Perplexity, they use ChatGPT, they use Claude, and everything gets filtered through this new interface. So that has happened with search, with information. Now we're seeing a similar thing happening, a similar shift with where do you buy things. So I think it's very probable that things like Shopify or Amazon might become backend services that take care of fulfillment. They take care of actually having the stuff that you buy in their storage, in their warehouses. But you might never go to Amazon again, or you might never go to a Shopify storefront again. You might just go to ChatGPT, type in what you're looking for, and then buy it directly through ChatGPT. It's very interesting. It's also kind of scary. The power that a platform like ChatGPT, like OpenAI, will have if this happens it's just unimaginable. There's a lot of questions around how will they rank results, how will they decide what recommendations are going to be shown to you, and what recommendations will not be shown to you. There's a lot of
There's a lot to unpack here, isn't it? So Samantha, help us unpack it. Is this an incredibly smart move by Stripe? Is this incredibly scary, as Sam says? What do you think?
I mean, at this stage of kind of diffusion of innovation, I think everything is equal parts exciting and scary, depending on which way you look at it. But it was broadly par for the course. Obviously, we've had announcements out of Google over the past year, most recently, their protocol, but before that, their view that they were going to become an engine of intent rather than search. And we know, obviously, the difference between agents and bots is that agents are there to focus on outcomes. So intent is super important. I think for me, what I'd like to start see surfacing, if I were to consider this in the landscape of, regulated financial services, is all of the things around consumer duty, financial literacy, the things that we need to be thinking about to make sure that we take this journey whereby we're leveraging the technology in the ways that consumers want to interact, but we're supporting them to do so safely. So looking at things like programmable spend behavior. How does the individual retain agency even when the agent is doing certain actions for them? And that is actually really, really critical. And I don't know how you would meet sort of certain requirements without it. So those things still need to kind of surface a little bit more for me. And you might say, okay, Sam, these things mature over time, but actually, the consumer behavior and expectations gets locked in surprisingly quickly. And then it's really, really hard to shift. You think about things like APP fraud, despite the millions of individuals and the millions of pounds that have been lost to that, the challenge that organizations have to get their customers to accept degrees of friction and then still act in the psychological moment, because everyone worked in a space where we were just used to clicking to get a thing done and not stopping to think. So I think we just need to step into this acting as if we are already at scale when we're thinking about what we're launching.
Thank you. Stephen, last word to you on this story. What do you think? OpenAI and Stripe, scary, brilliant, bit of both?
I think for Stripe, it's brilliant, right? Their payments orchestration, right? And, if you're thinking about what you want to do here, you want to enable ease of use, right, across the board. I think for OpenAI, it's creating a new mechanism by which people start to interact with shopping and shopping experiences, right? I mean, if you think about it today, what makes, some of the top end stores unique, right? You can think about Chanel and Hermes and all that, is that you have someone that creates a unique experience for you about what you want to do and how you want to shop. I think if you think about what you're doing in this OpenAI concept, people are already used to the idea of asking ChatGPT for suggestions around the board. I think to Sam's earlier point, and now you're able to start to create, unique experiences. Like, what should I buy for X amount for my 5-year-old niece? Right? That was something I didn't think about before, but imagine the basis that you could ask that into ChatGPT, and based off of a unique set of stores, it could suggest a set of things and then automatically pay, right? I think that changes the expectations to Sam's point of what experiences look like and how easy it is to change consumer behavior. I think what's concerning a little bit is kind of the speed at which this is happening in some ways, right? Because I mean, you really think about how much, payment services and banks have to think about things like fraud and all of those different components. There's no KYC on ChatGPT, right? And so think about the basis today, which is I'm enrolled in ChatGPT Premium and my credit card is already there. There's no verification basis to say that, when someone types into my phone or into ChatGPT, we can manage that. Now, there's a security basis to make sure it's actually from my account, right, and secure payment, but not the experience behind it, right? So I think there's a lot to think about, right? I mean, I do think, you're probably going to see tie-ins eventually to, like, again, what I'd say is like digital money on chain, and I'll bring that back, which is eventually you're going to have a wallet. That wallet is going to have a unique digital ID, right? That digital ID is accessed only through some like cryptographic or biometric basis. And then that's tied to then an interface or interaction that you'd have with a platform like ChatGPT, right? And then you create more of an end-to-end secure border, but still have like the same output in terms of experience. So I think, technology is evolving in such a way that we can start to, still have, innovation, but, increase some of the friction in a purposeful way, right? Hopefully over time that safeguards consumers, because I think that's going to be a big thing over time that regulators will have to consider and have to, solve for. So.
Indeed, I feel like that's the theme of this show, is there's a lot of work that the regulators need to do. So on that note, let's take a quick pause here and we'll be back very shortly. Okay, now for a quick look at one more newsworthy story this week that we don't have time to cover in full, but we think you'll find just as interesting. Which is that JPMorgan is ditching its Nutmeg brand in a digital wealth revamp. So JPMorgan is going to phase out the Nutmeg brand in the UK, replacing it with a unified offering called JPMorgan Personal Investing. The new platform will include a do-it-yourself investment service, shares, bonds and funds, and digital tools, as well as relationship managers for clients with over £250,000. Nutmeg, which was acquired by JPMorgan in 2021, has struggled to turn a profit, incurring tens of millions of losses in recent years, despite growth in assets under management. The move reflects JPMorgan's ambition to become a major player in UK retail investment and take advantage of regulatory changes allowing broader access to investment guidance. So this news is sad in some ways, because Nutmeg was one of the sort of early original cohort of British fintechs, and in many ways very successful in trying to create a wider market for investments, trying to make it easier for people to feel confident about building and managing their own investments. But at the end of the day, despite all the fabulous work that all the people who built Nutmeg have done, it does make sense for JPMorgan, with its much, much bigger brand, to brand those services under the JPMorgan brand, rather than maintaining a relatively less well-known UK-only branding. So it's a little bit of a rite of passage for UK fintech, but the right decision for JPMorgan in the long term, I think. And finally, now for something a little bit different from the world of business to finish this week's news show, which is that concert tickets aren't expensive enough, actually, says Live Nation's chief executive. So Live Nation chief executive Michael Rapino has argued that concert tickets have long been underpriced and should cost more. He compared concerts to sports events, suggesting fans should accept or even embrace higher pricing as a sign of value. Rapino cited rising production costs, such as touring logistics, and the scale of modern shows, such as Beyoncé's large-scale tours, to justify ticket price hikes. That feels like something it's fine for a rich person to say. I mean, are concerts really underpriced? Or is this just quite self-serving? I'm not quite sure who to start with on this one.
I was at the Oasis concert on Saturday, if that helps. And I feel like they are not underpriced. Don't get me wrong. I know that the value chain around the music industry has shifted drastically, and the income streams around sort of royalties versus merchandise versus touring in and of itself, sort of concert tickets, has shifted drastically over the decades, that they are more reliant on the income from these concerts. But there's also a point around accessibility. Let's not forget, music is one of the arts. Arts need to be open and accessible for all. And I think that needs to sit at the core, whilst recognizing the fact that there are economics around this that need to be serviced.
Well said. I find it hard to disagree with you on that. Steve and Sam, do you have a different perspective?
I'd say I have a pretty similar perspective in terms of they're pretty expensive. So I think there's probably a basis in which, folks need to think about, obviously value, and value is derived by the perspective that people put on it. So, I think right now, in the economy as we see it today, right, and what's happening, I think they're priced at a level in which people, view them as pretty luxury items. I don't think people go to concerts every day, especially those big ones, right? So, the experience is one of those things, and it costs money. But I do think it'd be difficult to say that without some monumental shift in production and the way things work, that the things on the back end, people would easily be able to justify that.
Yeah.
Yes, completely agree. I mean, as a startup founder, I admit I haven't been to a concert in quite some time. But I have seen what my siblings and what my friends pay to go every so often, and I don't think it's underpriced at all. And I do agree with Samantha that in the end, music must be available to as many people as possible. I think prices will just obey market dynamics. If people are willing to pay, they will pay. If not, they will not be able to. But my hope, especially for the artists and whoever decides these prices, is that they do take into consideration that they will and they should enable as many people as possible to enjoy their art and their music, because it's a good for the culture, for the country, for everyone involved.
I think that's very well said. I think we'll see artists that try to make their art accessible to as many people as possible, even while trying to generate a good income from that. Okay, well, that wraps up today's FinTech Insider News. It's been a fascinating and very complex set of topics we've gone through today. So thank you so much to all three of my guests today. You've been brilliant, unpacking some really complex stuff. Where can people find out a little bit more about each of you and your companies? Samantha, where can people find out a little bit more about you?
So the easiest place is on LinkedIn. Connect with me there, and we can have a conversation.
Sam, where can people find out more about you and Paygentic?
Yes, similar to Samantha, on LinkedIn is the fastest way to contact me. I'm always reading my DMs. Also, we just launched the new website for Paygentic, paygentic.io. So please check it out, and I hope to see you there.
And Stephen, where can people find out more about you and about Fireblocks?
Yeah, I'd say about Fireblocks, it's at www.fireblocks.com. And then in terms of reaching out to me, obviously, it'd be on LinkedIn and happy to chat with folks there.
And as for me, Benjamin Ensor, you can find me on LinkedIn as well. So thank you all so much for listening to today's FinTech Insider. If you like what you've heard, please do follow us on your favorite podcast platform of choice, and do share it with a colleague or a friend. If you want to join the conversation, seek us out on social media or just search for 11FS or FinTech Insider, or you can email us at podcasts@11fs.com. So thank you all again for listening, and thank you so much to my three guests for joining me, and bye-bye.
Ever wondered which UK bank or challenger has the best set of features? Well, thanks to 11FS Pulse, you don't need to wonder anymore. With its industry-first benchmarking feature, 11FS Pulse allows you to directly compare the holistic financial offering provided by traditional banks and digital challengers to see who is better serving their customers. Using Pulse's exclusive scoring metrics and jobs to be done methodology, dive deep into what makes each product stand out, from unique hero features to everyday banking necessities. And once you're done with benchmarking, there's another 17,000 hand-picked user journeys in Pulse's library for you and your product team to explore. Book your demo today at 11fs.com/Pulse.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001, or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster, so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's VANTA.com/insider.